In this video you will be seeing about stock markets. Stock markets are platforms where buyers and sellers trade shares of publicly traded companies. These markets play a crucial role in the global economy by facilitating the allocation of capital and providing liquidity for investors. Here are some key aspects of stock markets. Exchanges. Stock markets operate through centralized exchanges where trading takes place. Examples of well-known stock exchanges include the New York Stock Exchange, NYSE, NASDAQ, London Stock Exchange, LSE, Tokyo Stock Exchange, ZE, and many others. These exchanges establish the rules and regulations for trading and ensure transparency and fairness in the market. Stock symbols. Each publicly traded company is assigned a unique stock symbol, also known as a ticker symbol. These symbols represent the company's shares and are used to identify and track them in the market. For instance, Apple Inc. is commonly referred to as AAPL on stock exchanges. Stock indices. Stock markets often have indices that measure the overall performance of a group of stocks. These indices serve as benchmarks to evaluate the market's performance. For example, the S&P 500 in the United States comprises the 500 largest publicly traded companies and is widely used as an indicator of the U.S. stock market. Trading mechanisms. Stock markets employ various trading mechanisms to facilitate the buying and selling of shares. The two primary methods are the auction market and the dealer market. In an auction market, buyers and sellers place orders, and transactions occur at a central location based on supply and demand. In a dealer market, transactions are facilitated through market makers or dealers who bid and ask prices for specific stocks. Order types. Investors can place different types of orders in stock markets. The most common types include market orders and limit orders. A market order executes a trade immediately at the prevailing market price, while a limit order sets a specific price at which an investor is willing to buy or sell. Stop orders, stop limit orders, and trailing stop orders are other types of orders used to automate trades based on specific price levels. Market participants. Stock markets involve various participants, including individual investors, institutional investors, such as mutual funds, pension funds, and hedge funds, stockbrokers, market makers, and regulators. Each participant plays a distinct role in the functioning of the market. Volatility and risk. Stock markets are subject to price fluctuations and can be volatile in the short term. The prices of stocks are influenced by various factors, such as company performance, economic conditions, industry trends, geopolitical events, and investor sentiment. Investing in stocks carries inherent risks, including the potential loss of capital. Stock market index funds and ETFs. Investors can gain exposure to the overall market or specific sectors through index funds or exchange-traded funds, ETFs. These funds replicate the performance of a particular stock index, allowing investors to diversify their holdings and reduce risk. Market regulations. Stock markets are regulated to ensure fair and transparent trading practices and protect investors. Regulatory bodies, such as the U.S. Securities and Exchange Commission, SEC, in the United States, enforce rules and regulations governing securities markets. It's important to note that stock markets can be complex, and investing in individual stocks involves risks. It's recommended to do thorough research, seek advice from financial professionals, and diversify investments to manage risk effectively. Thanks for watching. Like, share and subscribe.